For anyone who can remember the days before the financial crisis, it's anything other than a dream. We used to have LBOs that were $10 billion or bigger. Haven't had one for quite a few years. There was some talk this week, though. Rob, what was the story?
Well, there's a company called LabCorp of America. It's diagnostic testing,
Right.
not a very sexy business, but it's steady cash flow. It's a big company. It's about $9 billion or so.
Right, and so to pay a premium, it would have to be a $10 billion.
It'd be almost $10 billion, yeah. And the thing is, it looks like a great bio candidate. It's got great cash flow.
Right.
You know, it's a stable business. It'll actually grow a bit under the Healthcare Reform Act. So it's the type of thing. The problem is, it's a really big company, and what that means is you have to. It's going to be hard to swing.
Right, so, but you have a couple of things, right, JB?
You need a big equity check. The thing is private equity firms, especially the big funds that were the ones that would be involved with a $10 billion LBO, have a ton of equity to put to work.
Right.
They've got, on the verge of $160 billion of their own committed capital from their investors.
Right.
Leverage that 3 times. You're talking about a $500 billion
So they're looking for
of
stuff
capital.
to do.
They're looking for deals. They want big deals. And there's some suggestion in the market that terms are getting easier. You could get to a $10 billion deal. They haven't flirted with one for a couple of years. The Blackstone and some others were looking at a company called Fidelity National Services a couple of years ago. Came close to a deal. It didn't happen.
Well, the thing is, it's easier to get the debt. I mean, you can borrow more debt, but you still have to put in a big check. And that would be, for a company that size, it'd be about a $4 billion equity check. And that's just too big for any one fund.
Right, so they'd have to get together, which they used to do, right?
Yeah, they used to get together on these things called club deals, where more than two is a little bit more common. 3, 4, we saw some deals that had 7 or 8 firms, and they could put their equity together, do a big deal, bring in some co-investors. But I mean, those deals really get messy, and I think they learned their lesson. One of the biggest problems is that these firms are trying to differentiate themselves with investors, even more so now that they're publicly listed.
They all do the same deal.
It's sort of like, well, how do I know who's better, who's doing what? So you have that as an issue. There's some other things.
The other problem is getting out, of course. If we're all invested and I want to get out, but you're staying in, then it's a question of what sort of terms do we drop.
Right.
And then even managing the company, like I may say, okay, let's go for growth. You may say, let's go for cash, and you may say, let's get our money out as fast as we can. And all these, they're all fighting. It becomes very difficult to manage these companies.
So just quickly on the debt on this one. I mean, you said it's a steady cash flow company. That's good, but on the other hand, that's not that exciting. So to get a return out of that, of course you want to grow it, but also a little bit of financial engineering helps. Yeah. And debt ratios have not been so high. So it hasn't been so easy.
This year they've been around, on average, they've been around 5 times as a debt. They've been able to borrow 5 times EBITDA. Yeah. But we just saw a big deal a couple weeks ago with Carlyle and another firm buying out a piece of United Technologies, and they got close to 7 times.
6.5 times,
yeah. So I mean, that's how you make a deal like LabCorp work.
But of course, a big deal may be harder to get that kind of multiple.
Right. True.
Right. Okay, we'll leave it there. We'll be keeping an eye out for the next $10 billion LBO. Might be this year, might be in 5 years' time, and we'll have more breaking views next week.